Hello everyone. The purpose of this video is to learn how to work with pro-forma statements. We're going to look at theoretically the basics of creating pro-forma statements for income statement and the balance sheet, and we will go through an example as well. So first of all, we're going to get started in this tab, My Financial Statements, in your Excel file. If you haven't created this yet, please watch the prior videos and create this. We have created a kind of a detailed income statement here and also a balance sheet. But we also reviewed a few things before leaving off last time. Before moving this information off, let's re-review. We said that internally generated funds for a firm are represented by retained earnings, what's left over after they've sold the shirts and paid all of the costs related to the shirt sales. Retained earnings are retained and reinvested back into the business right here. External funds, unlike those that are generated internally, that a firm can raise from external sources. And they represent debt, short-term and long-term, and common stock, bringing in money from new owners. So let's go ahead and move this review off from here just to free up space. So I'm just going to put it here. And we actually don't need the super simple part, the income statement, balance sheet, and statement of cash flows. Hopefully everybody has this memorized. If you don't, please make sure you memorize it. Or I'm going to just hide it for now. This will allow us to concentrate on the income statement and the balance sheet. And what we're going to do today is we're going to create step one projections or pro formas. And this is going to be a simple case. Why do firms create projections into next year using the historical information from the previous year? Here in the financial statement example, you can see historical information for the income statement and two historical information years for the balance sheet, as well as historical information for the statement of cash flows. So why do firms need to project income statements and balance sheets into next year? One of the main reasons is to understand whether the firm will have a need for external funds next year. It's called EFN, external funds needed. Simply, it means whether a firm needs to borrow to support next year's growth, and they will need to borrow if internally generated funds are not enough to pay for the firm's growth. So let's assume that next year a firm is going to grow at 10%. I'm just going to put 10% here. Let's talk about how each account on the income statement and the balance sheet grows into next year in a projection. So sales growth is one of the most important predictions that a firm can make, and that's estimating how many more shirts am I going to sell next year. If I'm selling 100 this year and they're going to go 10% next year, I plan to sell 110 shirts next year. So sales growth projections are fundamental for businesses in terms of understanding where does a business stand. When you're asked, is this firm growing? What you're really being asked is, are the sales over time going up for this company? And sales growth is a main factor in understanding whether or not a firm is growing. But sales growth is also important because it influences other accounts on the income statement and balance sheet, and it makes intuitive sense. So if sales are growing at 10%, other accounts on the income statement will grow with sales, and many accounts on the balance sheet will as well. So let's take a look at that. Cost of goods sold will grow with sales. Why does this make sense? It makes sense because as you sell more shirts, you need to have more material. So cost of goods sold will be growing with sales too. Next, we have gross profit. Gross profit is a sub-summary. So we're just using the formula we've had before. Operating expenses, as you sell more shirts, you need to keep the factory lights on for longer and the sewing machines working more to sew those shirts. So operating expenses, sales, general, administrative expenses will also grow with sales. Next, we have a sub-summary for operating profit. Interest. Interest is paid on debt, and debt is an external account. And in step one projections, all external accounts are going to stay unchanged because the whole purpose of the step one projection is to see whether firm will need external funds next year, whether they need to go to the bank in the first place and borrow. Perhaps internal funds are enough to support the 10% growth next year, perhaps not. So we're going to keep all of the external accounts unchanged on the balance sheet and the income statement for step one pro forma. So this might create an unbalanced balance sheet where total assets might not equal liabilities and shareholders' equity in your projection. And that's what's going to tell you whether a firm will need to go and borrow, raise external funds. Next, we have a sub-summary for taxable income right here. Tax is a percentage of taxable income. So if you make $100 and your tax is 28%, you pay 28% to the government. Net income, your biggest subsummary of them all, also known as earnings. And then we have dividends. Dividends are oftentimes given to you as a payout ratio. And payout ratios represent dividends as a percentage of net income. So if your net income was 100, your payout ratio is 30, you're going to pay 30 to your shareholders in the form of a dividend. And then we have retained earnings, which is what you get to keep and reinvest back in the business, also known as internally generated funds. That's net income minus the dividend. We are done with the projections for our income statement, and this is your income statement pro forma for next year. Let's take a look at the balance sheet. And the first account that we're going to project on the balance sheet is the link between the income statement and the balance sheet, or the internal financing, the retained earnings. Whatever is left over after you paid all of your costs and you are retaining to reinvest back in the business is going to come from the income statement and literally gets put back on the balance sheet. Balance sheet is a cumulative statement. So you will take whatever was in the balance sheet retained earnings account and add in the new money coming in from the income statement. So the retained earnings on the balance sheet will equal prior year's balance sheet retained earnings plus the pro forma or your next year projection of retained earnings on the income statement. So you're literally reinvesting internal money back into the company to support this 10% growth. This will support the asset growth needed to support the 10% sales growth, which brings me back to the beginning of the balance sheet. Let's start with assets. All of asset accounts in a very simple projection will actually grow with sales. And again, that makes sense. So if you think about your inventories right here, inventories will need to grow with sales as you plan to sell more shirts, right? Then, you have accounts receivable. You will need to give more credit to your customers as you plan to sell more shirts. And property, plant, and equipment, you will need to have more sewing machines to sew the extra shirts. So all of these accounts naturally grow with sales at 10%. And usually firms also will keep cash proportional to sales increases. So altogether, total assets are growing with sales in the simple setup, but I won't say it. We will always want to total up your total assets across all asset accounts. This is all for pro forma balance sheet asset accounts. Next, we need to look at liability and shareholders' equity accounts. And we've pretty much filled out all of them except for one, except for accounts payable. Accounts payable, along with accounts receivable and inventory, are operating net working capital accounts, meaning you need them to run the operations of the business day to day. So as you sell more shirts, you need to have more inventories, give more credit to your customers. As you have more inventories and you need to have more cloth and thread for your shirts, you will need to have more credit from your suppliers. So accounts payable will also grow with sales, just like all operating accounts payable, accounts receivable, and inventory. Then we have our debt accounts that are at least unchanged for now. And if the firm will need external funds, this is where they will come from. The firm will borrow, likely from a bank. They want to know if they need to go and talk to a bank ahead of time. And also common stock. And we've also brought in the internally generated funds already. What remains is a summary for total liabilities and shareholders' equity. And this is really your accounts payable plus short-term debt plus long-term debt plus common stock plus retained earnings. All right. We're done with a theoretical portion of step one, projections, pro forma statements. Let's go ahead and make it operational and put some numbers to it. So go ahead and click here under the pro forma statement, and you have an example that you can bring in. So literally just copy all of the information starting here where it says example in green, push it down and bring it over, then right mouse click copy or Control C, and let's go back to my financial statements, and let's go ahead to the very top at this row 7 and push Control V or right mouse click paste. So you've pasted the information in, everything should match up. Here are your sales, and I'm just bringing in the income statement here so you have the accounts close at hand and not so far as right here. Here are all of your balance sheet accounts. It says here, example, fill out all the green cells, assume 10% growth. So you're going to assume 10% growth. And your most important part of this assignment is to create this projection. Remember, the reason why we create projections to next year is to understand, does the firm need external funds? So initially, all of the external funds remain unchanged. And the firm knows whether it needs external funds or not by looking at next year's pro forma and comparing total assets to liabilities and shareholders' equity. On a normal balanced balance sheet, these should be equal. Total assets equals liabilities plus shareholders' equity. That is the balance sheet identity. However, in step one pro forma, if a firm needs external funds or if it has some extra money, we are going to have this unbalanced. And if our next year's total assets are predicted to be greater than the total of liabilities plus shareholders' equity, which is at this point mostly funded with internal funds coming from the income statement, it means that internal funds are not enough to fund the growth in assets needed next year to fund the growth in sales that's happening that next year. So your goal is to come up with these projections and figure out, does this company need external funds? But before you start, you need to create historical information too. You've already seen historical information here. You're going to come up with your own historical information for the income statement and the balance sheet. I'm telling you that cost of goods sold are 65% what? Well, oftentimes cost of goods sold is given as a percent of sales. And so 65% of sales is cost of goods sold. So this should be $65. Then I'm telling you operating expenses are 28%. Again, oftentimes operating expenses are quoted as a percentage of sales. So this is 28% of sales. Then I'm giving you information on interest. I'm also telling you the tax is 21%, and tax is going to be a percentage of your taxable income. Dividend is 32% payout ratio, so it's going to be 32% of your net income. So go ahead and create a historical statement. Then you will finish up the historical balance sheet, which you're mostly given with the exception of the total assets and liabilities plus shareholder equity summary. And when you're done with the historical, go ahead and create a projection. In the next video, we're going to go through all of these accounts and create the projection for historical and pro forma statement with 10% sales growth.